Investment policy. Your investment plan also includes your investment policy, which is a written statement of what you will and will not invest in, how you will allocate your investments, and how you will distribute your assets. Your investment policy is divided into 6 areas. Acceptable and unacceptable asset classes. In your investment policy, you will need to state which asset classes you will and will not invest in. It's important that you decide which assets you will invest in before you begin investing so that others will not be able to convince you to invest in asset classes that are not suitable for you at your stage in the financial life cycle. Invest only where you have a particular expertise and where the odds are in your favor. You should plan to invest in asset classes that have a history of delivering long-term returns and not just high returns over very short periods of time. So what you need to do is to review the historical performance of various asset classes to roughly estimate future performance. And after reviewing the historical performance of the various asset classes, it's likely that you will decide to invest in either mutual funds or stocks, whether this be large, medium, or small capitalization stocks, international stocks market, and emerging markets. Or it can also be bonds and cash equivalents, which are mostly short-term, long-term, government and corporate bonds, money markets, certificate of deposits, commercial papers, government papers, and maybe even in real estate, such as the real estate investment trust, or what we call as REITs, and mutual funds of real estate properties. And once you have identified which asset classes you will invest in, you must also determine which asset classes you will not invest in. Asset classes of this list may include those which you do not have any expertise or those in which the odds are against you. For example, this could be foreign currencies, wherein you have a zero-sum game, which means that for every winner, there must be a corresponding loser. And typically also this could mean requiring a great deal of expertise if you want to invest in commodity futures contracts, precious metals, or even the art. The rule to follow is be cautious of investing in those areas unless you have specific expertise to support your investment decisions. Investment benchmarks. Investment benchmarks are typically a hypothetical investment portfolio that show how a specific set of assets perform over a specific period of time. These portfolios can help investors evaluate how their investments are performing versus how the benchmark is performing over the same time period. And unless you have a benchmark or a standard by which you can judge your investment's performance, you cannot know how your investments are doing. Therefore, investors normally select benchmarks based on either asset classes, size or capitalization, geography, issuer, and investment style. Asset allocation. Asset allocation is the process of determining how much you will invest in each specific asset class in your portfolio. The research of Ibbotson and Kaplan has shown that the decision of how to allocate your assets is the most important factor affecting your portfolio's performance. And in your investment plan, you should be answering the following 5 questions. One is, how much will you invest in each asset class? Generally, your choice starts between stocks and bonds. One time-tested way is to use your age as a percentage of the allocation of your bonds. The second question refers to what percentage of your total investments will you invest in each asset class? If you are an aggressive investor, you should decide to increase your equities allocation. On the other hand, if you are a conservative investor, you can decide to increase your bonds allocation. Third question, what is the minimum allocation of funds you will invest in each asset class? We talk about preserving diversity in your portfolio, and this is an important tool with which you can reduce your risk. The fourth question, what is the maximum allocation? This will signal that it is time to rebalance your portfolio back to a target allocation. And the fifth question, what is your target allocation? This is the ideal allocation based on your current expectation and the current market conditions. Investment strategy. Investment strategy describes how you will invest your money. It will clarify how you will manage, prioritize, and fund your investments. It will also describe how you will evaluate new investments. So the following are what is needed to be answered. These questions refer to 1, will you use active management or passive management? We know for a fact that active management refers to trying to outperform the benchmarks by actively buying and selling stocks and bonds. Passive investments, on the other hand, is a strategy in which you will invest in index funds or exchange-traded funds instead of trying to beat your benchmarks. And this is often the strategy that is cheaper in terms of time and cost, and it's often more tax efficient as well. Number 2, will you invest in individual assets or mutual funds? Investing in individual assets allows you to control what you invest in. Mutual funds, however, offer the benefits of diversification and economies of scale, and you may also choose to invest in a mixture of these assets. Third question, will you use leveraging in your investing? Using leverage is not recommended. While it increases the potential for your return on investment, it can also magnify the potential for losses. Funding strategy. You cannot invest without having the funds to invest, and you should not invest with borrowed money. So therefore, where will you get the funds that you need for your investments? Most financial planners will recommend that you will save a minimum of 10% and when you're young, and they will recommend that this amount should increase as you get older. Once you set aside, let's say, the recommended 10 to 20% of each month, then you should be able to invest your money wisely and follow your personal investment plan. But how will you manage the funds for your various financial goals? One way is to save for different financial goals, is to set up different investment vehicles for each of your financial goals. And you can use either the 401k or other funds that you can invest for your requirement. You can also set up investment accounts to save for an emergency fund, a house down payment, or even a car fund. New investment strategy. How will you handle new investments? You need to decide the maximum percentage you will allocate to any new investment. Most experts advise that this amount should not generally be more than 10% of your investor's assets. You have to decide how much of the maximum amount you're willing to invest with a single investment. In other words, decide how much you will be willing to lose with such single investment. Decide also on the maximum amount of your company stock that you will include in your retirement account. For most people, this should not be more than 5 to 10% of the funds in your retirement account. And always remember the principle of diversification. Portfolio monitoring, re-evaluation, and rebalancing. This is the final part of your investment plan, and you have to describe how you will monitor, re-evaluate, and balance your portfolio. Monitor your performance. Compare the performance of each of your assets against the benchmarks on a monthly, quarterly, and annual basis. How did your assets perform? Which assets had returns that were greater than their benchmarks, and which assets had returns that were less than their benchmarks? Setting goals is not a one-time event. You should continually review and re-evaluate your goals. Your situation may have changed in life, and which goals therefore need to be changed to accommodate that change in the situation of your life. Finally, has your portfolio shifted away from its target asset allocation because of time or because of the performance of your assets? How will you now rebalance your portfolio to regain your target allocations, while at the same time minimizing the tax effects of rebalancing?